All right, let's dive into this explainer and completely demystify exactly what happens when a major financial institution collapses. I mean, we constantly hear the buzzwords, right? Bank runs, bailouts, market panic. But the actual nitty-gritty mechanics of a financial rescue, those are rarely brought into the light. So today, we're pulling back the curtain. We're going to use regulatory frameworks and historical precedents to explore the true anatomy of a bank failure.
And really, it all boils down to this. What actually happens to your money if your bank goes bust tomorrow? That is the ultimate question for everyday savers and investors. And we're going to break down the hidden, behind-the-scenes mechanics working to save the system. Look, it's an uncomfortable thought for sure, but an absolutely essential one. Are your hard-earned savings just going to vanish into thin air? Will taxpayers be forced to foot the bill yet again? Well, to answer those questions, we really need to understand how regulators approach a failing institution today.
This quote here perfectly sets the stage. The essence of banking is solvency, and an insolvent bank is, by definition, not a going concern. So what does that actually mean? Well, unlike a regular retail store, a bank simply cannot function, even for a few minutes, if it loses its solvency and the trust of its clients. Think about it. A bankrupt retailer can stay open, run a massive clearance sale, and slowly restructure. A bank? No way. It relies entirely on confidence. The second it tips into insolvency, the business just stops instantly, leading to a sudden liquidation that destroys massive amounts of value.
When an institution starts tipping over, it's literally like a massive ship taking on water. It creates this immediate, systemic threat that requires incredibly aggressive stabilization. You can't just casually pump the water out over a few months. Why? Because the global financial system is deeply interconnected. The failure of just one massive institution can instantly drag down dozens of others, choking off credit to businesses and completely freezing the broader economy.
Okay, Section 1, the 50-hour rescue window.
Now, you might think complex financial restructurings take months of careful planning, right? Actually, regulators are usually in a frantic race against the clock. They have a strict 50-hour window. That's from the U.S. markets closing on Friday evening to the Tokyo markets opening on Monday morning. That is literally a single weekend to restructure billions and sometimes trillions of dollars. Before Asia opens, they have to decide exactly who takes the losses and basically prove to the world that the bank is safe again. Talk about a stressful weekend.
Moving right along to Section 2, the bail-in revolution.
So how do they actually pull off a weekend rescue? Well, authorities have made a massive shift away from the old, highly controversial era of taxpayer-funded bailouts. Instead, they use what's called a bail-in. The crucial point here is that a bail-in forces the bank's own investors and creditors to absorb those massive losses overnight. By legally changing the terms of the bank's debt, regulators can basically wipe out the losses and restore the balance sheet from the inside out.
To really understand this modern shift, let's look at the stark contrast. A bailout uses new, public, taxpayer money to save the bank. The public foots the bill. But a bail-in? It uses the bank's existing liabilities. It's a mandatory internal restructuring where specific bondholders take the financial hit. It's designed to keep the general public completely off the hook.
Let's break down who actually loses their money. If we look at the capital stack during a bail-in, equity is entirely wiped out first. Then subordinated debt is either erased or converted into new shares. And finally, if things are really bad, senior debt is partially written down. That's the explicit pecking order. The original shareholders are wiped out completely, which makes sense, they took the ultimate risk. Then subordinated debt holders take the hit. And if the financial hole is deep enough, even the senior debt holders will face a haircut, meaning a big percentage of what they're owed is simply canceled.
Let's ground this with a real-world example from our sources. Imagine a massive trillion-euro bank facing a sudden, devastating 80 billion euro loss. Now, this bank only has 50 billion in share capital and 20 billion in subordinated debt. Add that up, and that's 70 billion in total protection. But remember, the loss is 80 billion, so that loss burns completely through their safety layers. Under normal circumstances, this bank is dead in the water.
But here is how the weekend bail-in saves the day. Regulators step in and they completely cancel that 50 billion in share capital and the 20 billion in subordinated debt. Poof. Just like that, 70 billion of the loss is covered. For the remaining 10 billion, they write down the senior debt. Finally, they convert 70 billion of other eligible debt into brand new equity. So, by Monday morning, the bank opens its doors fully solvent. And the best part? Everyday retail depositors haven't lost a single cent. It didn't cost the taxpayer a dime.
Which brings us to Section 3,
the FDIC safety net. So while investors and bondholders are playing this high-stakes game of bail-ins, where does that leave you and me? Well, everyday consumers are insulated by a totally different mechanism, the FDIC's magic number, which is $250,000. Whether your bank faces a weekend bail-in or gets sold off for parts, if your money is in a qualifying checking or savings account, it is guaranteed dollar for dollar up to $250,000 per depositor and per insured bank.
And check this out. No depositor has ever lost a single penny of insured deposits since 1933. That is an incredible historical fact, and it should provide massive reassurance. It proves that the FDIC acts as a totally reliable firewall for your everyday checking and savings accounts. Since it was created during the Great Depression, the FDIC has had one primary objective: public confidence. And honestly, that 100% success rate since 1933 is the absolute bedrock of that confidence.
However, and it's a pretty big however, it's also a historical reality that during truly extreme crises, governments have utilized exceptional statutory measures to stabilize the economy. Our sources point out that in totally unprecedented, acute systemic failures, governments might resort to extreme actions. We're talking about temporary freezes on savings accounts to stop a bank run, or even extraordinary tax increases and levies. While these moves are rare and highly controversial, just understanding that these tools exist in the government's crisis playbook really highlights why relying entirely on just one financial safety net might not be enough.
That leads us perfectly into Section 4, Gold as a Safe Haven.
When systemic trust breaks down entirely, people historically look to the oldest wealth preservation tool in human history: gold. Why? Because gold cannot simply be magically printed out of thin air like fiat currency. Its limited supply helps it maintain or even increase its value when paper money loses purchasing power. Central banks can hit print on a computer, but extracting gold requires massive physical effort. So when inflation acts as a silent thief in the night, gold serves as this historical bulwark. But our sources make a really vital distinction here: the difference between holding physical gold and paper gold. Paper gold, like ETFs, is incredibly convenient, right? But ultimately, it still relies on the very banking system that might be in crisis. If the financial institution freezes, you are locked out of your investment. Physical gold, on the other hand, stored privately, offers direct protection and true independence without that counterparty risk.
All right, let's wrap things up with Section 5, Securing Your Savings.
So what actionable steps should you actually be taking today? Look, returning to smooth sailing and peace of mind is all about taking the right preparatory steps while the economic waters are still calm. You absolutely do not want to be figuring out your emergency plan on a Friday evening when a major institution is teetering on the brink of collapse.
Here is a concrete survival guide for your savings. First, assess your true financial needs. Exactly what liquid cash do you need to survive? Next, don't put all your eggs in one basket. Diversify across stocks, bonds, and precious metals. Keep a cash reserve easily accessible. Absolutely limit those large, uninsured sums. Do not keep balances over that $250,000 FDIC limit at just one single bank. And of course, consult with professional financial experts to tailor a plan just for you.
Which leaves us with this final, vital question for you to consider. If the 50-hour rescue clock started ticking today, is your financial umbrella ready for the storm? If regulators were locking themselves in a room right this second to restructure a failing bank through a massive weekend bail-in, are your assets properly positioned? Look, understanding the true anatomy of a bank failure isn't about fear or panic. It's about preparation. It's about ensuring that no matter what happens in the wider economy, your personal financial